Hello, this is Bert Dohmen, March 18th. Today the Federal Reserve released its statement after the meeting and decided to remove the word patient from its statement, which was ridiculous in the first place. The Federal Reserve does not lead the markets, it follows the markets, and the Federal Reserve is in no position to raise interest rates in an environment of great deflation worldwide, which is worsening as we speak. To see some evidence of this, let's look at this chart of the DBC commodity index. Commodities are very important. And you can see here in 2008, as the world started going into the crisis, the commodity index started plunging. This is way before most people had even any inkling that the markets were deteriorating. We, of course, were already positioned nicely on the short side and benefited from the plunge in commodities in the stock market, etc. And here you can see this decline into early 2009. This was absolutely horrendous. The rallies after that went into the peak in 2011. And this is very interesting. You see the small dotted lines here? These are Fibonacci retracement levels. And you can see here this rally was right back to the 50% level. This is 50% here. I'm sorry, the number is so small, but the program doesn't make it any larger. This is 50% of this big decline. A 50% retracement is very normal in a bear market. So because it could not get above that 50, we concluded that the commodities were still in a longer term bear market, a secular bear market. And this is where we are now. Since that time, commodities have been declining. We've had some good sharp rallies in here where everyone got hopes again and went bargain hunting. But we thought that deflation was the bigger problem, much bigger than inflation. Here we can see in June 2014, last year, it broke this support level. This was a very important break. When any chart, whether it's a stock or an index or a commodity in this case, breaks an important long-term support like that, you have to pay attention. And so we saw this big decline after that, and it actually broke the global crisis low of 2009. This is so significant, I can't even tell you. It's almost scary if you know technical analysis. It went down to here. The normal behavior of a chart then is to have a throwback rally. This happened in March. It went right back to the breakout level here, and now is back down and broke the prior low here early this year. This now usually is followed by another sharp decline. If it happens, you can forget about the Fed raising interest rates this year, or probably not even next year. In fact, our forecast a year ago was that the next big move by the Federal Reserve would be not to hike interest rates, but to lower them and to introduce another big stimulus program, similar to what Japan has done, similar to what the European EBC had done. So take this as you want to. Just remember it. This is very bearish for the global economy, but it also means continued new money printing by the central banks, which the only place that money goes is in the investment markets. So as bearish as this is for the economies, it's bullish for the investment markets. Of course, it does introduce a high degree of risk. Thank you. This is Bert Dohmen signing off. Join us again for another episode soon.